The closer Toshiba comes to choosing a buyer for its memory chip business, the more the conglomerate looks like Schrodinger's cat, unknowably dead or alive until a $20 billion deal opens the box and defines the situation. Its stock suggests the market shares that view. With the prospect of delisting still real, Toshiba shares are 28% lower than they were the day before its multi-billion-dollar nuclear write-down crisis came to light in late December, but 28% higher than they were the day after. When an agreed sale of the prized chip business emerges, as it may do after a board meeting on Wednesday, it will resonate beyond Toshiba itself because, for all of the uniquely Toshiba elements, this crisis has consistently waved red flags over wider corporate Japan, the stock market, and the regulators. The three imperfect deal choices, led respectively by Bain, KKR and Foxconn, before Toshiba's management, meanwhile offer daily reminders of how thoroughly the Japanese government, directly involved in two of the bidding consortiums and tacitly opposed to the Taiwanese-led third, believes in the importance of its market role, however unwelcome that interference is to investors. If all of these concerns are set aside in the excitement of Toshiba's rescue via the sale of its chip business, investors may, and it's a tenuous may, revisit the charms of a Japanese market where 40% of stocks are trading below book value and corporate profits are at all-time highs. But Toshiba itself should expect to miss out on any euphoria. Whichever of the three deals it accepts, the company should see its net cash return to about 650 billion yen by the end of its financial year in March 2018, and its equity capital bounce back to around 950 billion yen. Healthy in theory, but also the balance sheet of a company shorn of both its profitable chip business and its prospects of long-term growth from nuclear. New Toshiba will, according to some forecasts, have a return on equity below the 5% line associated with good corporate governance, and has yet to shake the criticism of its former auditor, PricewaterhouseCoopers, that Toshiba suffers from deficiencies in internal control. A deal may be done, the shares may briefly surge, but it will surely be a dead cat bounce.